Welcome back to another video of Hoot and Poop. So I hope you have enjoyed the previous video on options introduction. So in today's video, right, I will be talking in depth on option strategies. Okay, so without further ado, all right, let's proceed with the sharing. So in today's series, it's called the call option. Right? If you can recall, in options, we have the call and put options. So this time out, I will be talking about call options. Okay, so just to get my definition right and to invite both of my friends, Freddie and Nancy, up again. So call option, we have the buyer and the seller. So for the buyer, you have the right to buy the shares at an agreed price stated in the contract. So in summary, you can choose to buy, you can decide to buy the shares if you wish to for the buyer of the call options. Now, for the seller, you are obligated, or rather you are obliged to sell the shares at the agreed price if the buyer chooses to exercise his rights. Okay, so that's the definition. Now, generally, when we carried out call options strategy, it is more of a bullish bias. So what do I mean? Basically for me, how I do my call options is that I usually purchase leap calls, purchase long calls in some sense, meaning to say, I will always tend to be a buyer side for call options. Why is it so? Because being a buyer of the call options, right, I want the share price to be higher than my agreed price, to go up higher and higher, so that when the share price goes up higher and higher, right, the value of my contract will increase. And by then, okay, I can choose to sell off my contract at a profit, or I can exercise my shares to buy the shares at a cheaper price. Okay, so this sounds confusing, no worries. We will go through a little bit of examples to allow you guys to know. Now, you can, for call options, or rather for call options, you can choose to be a seller of it. However, by selling a call options, it means to say you are expecting the share price to go below it. If not, you will incur loss. So I generally don't short the market, or rather I generally don't bet against the market when I do my option strategy. Okay, now I will try to go through this whole thing again. So now in the screen on the left is a contract, rather, and a call options contract. On the right is a stocks. Okay, so when you buy anything, regardless of stocks or options, there will always be a cost incurred. Now, as you all know, a contract, okay, represents 100 shares. But to purchase the contract itself, you do not need to pay 100 times of it. Okay, what do I mean? So basically, if you were to purchase 100 shares from the exchange, from the market, okay, maybe one share costs about $10 for now. You will need to incur $1,000 to purchase 100 shares. Okay, however, to purchase the contract that controls 100 shares, right, that has 100 shares within the contract, you only need to pay $10, for example. All right. So this is the cost you need to pay to control the same number of shares in some sense. Okay. So basically, if the share price moves, that means to say when you purchase it, when you purchase one share of $10, right? You purchase 100 shares is $1,000. So when the share price move to, let's say, $20, okay, the worth of your contract will go up as well. Okay, so just take note, when the share price move, your contract will move as well. However, the catch is that your share price must move in a way, must move quite significantly for you to see an impact to your contracts. Okay. Now, I'll always like to talk about the cost as well as the risk, because I don't like to give you all the positive things without understanding the risk. So for the risk of options versus shares, if your share price plunged, you will suffer paper loss from your shares. For your options contract, it's the same. When the share price plunge, the worth of your contract will drop as well. And this drop will incur some losses. Okay. However, please note that the difference between stock and contract is this thing called the time value. So what do I mean? So when you buy a stock, okay, if the share price plunged, you can just hold it for long term, and then if the fundamental of the business is good, naturally, right, the share price will rebound back, will go back most of the time if the company fundamental is good. However, for contract, if you remember, there is an expiry date to it. Remember, in my previous video, I said before, the expiry can be a month. It depends on the contract you buy. It can be a monthly contract or can be a weekly contract. So there will be an expiry date. So if on expiry, if the share price after dropping don't recover back and don't recover fast enough, your contract may suffer permanent loss on expiry date. So this is the pain point of an options contract. Meaning to say, if the share price moves upwards, you benefit a lot. But if the share price drops and don't recover back on time, and on expiry date or nearer to expiry date, your contract's value will just be affected and you will suffer permanent losses. But for stocks, it's different. You can hold as long as you want. There is no expiry as long as the company is still there, as long as the company is still listed. So this is the differences between these two. So just take note, right? When it drops, it affects both of it. And of course, the cost it affects is stated in here, 1,000 for the shares, but contract is $10. However, just always remember that the contract and options, there is this thing called the expiry date. Okay. Now, I just want to run through some examples with you so that you can understand, what's the rough calculation of the value of the contract when the share price moves. Now, let's take note. The thing is, I didn't want to bring in too much technical things in this video. So there are also, things to consider. For example, in terms of, options world, there is this thing called the time decay value. So what I mean by time decay, meaning to say when nearer to the expiry date, okay, the worth of your contract will depreciate faster, etc. So this one I will talk in my next video and I'll also see whether if there's any other suitable things to bring up. The next thing I also want to share with you guys is that in options, we have this thing called the options Greek. So we have delta, we have gamma, we have vega, we have theta. So each of these Greeks constitutes to different components that affects the options contracts value. Okay, so we have, for options, we also have intrinsic and extrinsic value as well. So all these things, it's a little bit technical. So I will go through them again, all right, in my next video. But for now, I just want you to understand the mindset of it, is that how I conduct my options trade, because generally I do not short the market. I don't like to bet against the market, because and of course I do hear people say that you must hedge here, hedge there, so that in case of market downturn, you can profit here and there. Now the thing is, we will never know when market will go against you, but most of the time the market is always up in the long run, as long as the company that you choose is good. So my greatest hedge against market downturn is my research on good companies, and that's all it matters to me. Okay, so because of that, all my videos that I will be talking about regarding options are all bullish bias. I do not recommend shorting the market, especially if you're starting out investing. Okay, so I just hope this whole thing is clear. Now, going back to my example, okay, so let's say, for example, for Facebook, it's $100 today. Okay, it's not really true because Facebook is almost it's above $300, But just for example's sake, right, just assume that Facebook today is trading at $100 per shares. Okay. Now, I am a buyer for this example. I am a buyer of a call options contract for Facebook, and I buy it for, let's say, 1 month duration. Because no matter what, every contract, there will always be a duration. So take note, this duration, okay, is the expiry of it. So if, let's say, just like my previous part, I actually mentioned that if the share price drop and it don't recover, nearer to the expiry or on expiry date, this contract will suffer loss. So this is what I mean, okay? And if, let's say, like, this contract agreed price is $100. So in basically what we're trying to say is that being a buyer, you own this contract, okay? You have the rights to buy the Facebook share at $100, right? Take note, one contract represents 100 shares. That means to say you need to multiply by 100. Means to say $100. Let's say, for example, this contract agreed price is $100. If you choose to exercise it to buy the shares, you need to fork out $10,000. That's the whole thing. Or alternatively, you can also close the contract by selling back off the contract to profit from the gains. Now, I will show you the example later. Take note, as a buyer, you will need to pay up some premium to buy the contract. So example, the contract, right? You pay $5 to just buy this contract. Okay. Now, if, let's say, nearer to expiry or on expiry date, Facebook share price is $150. So what is the worth of this contract? You just do a simple calculation. You just need to take $150 minus off the $100, which is the agreed price, okay, of the contract. Now, your worth of the contract, because Facebook share price went up by $50, the worth of the contract is $50. Okay, so just remember, for a call option, to calculate the worth of the contract, a very rough calculation, you just need to take the share price minus the agreed price, and this is the worth of it. So to calculate your profit and loss, your profit basically for this contract is $50, and then you need to minus off the premium that you paid is $5. So basically your profit and loss is $45. Now this excludes all the commissions that you need to pay when you buy the contract or when you sell the contract. So I'm not excluding all this small little money. I'm just giving you a rough picture. And take note, this is not always true, because we still have to factor in a lot of time decays and a lot of the options grid, which I will go through it again. I just want you guys to have an understanding of how it's like. Okay. Now, being a buyer, if the Facebook share price went up by $50, okay, you profit about $45 after deducting the premium you paid, which is $5. On the other hand, the seller will lose $45. Okay. Now, if, for example, if Facebook share price don't move, stays still at $100, okay, the worth of the contract is $0. Why? Because the share price, which is $100 minus the agreed price, is $0. So your profit and loss for this contract is -5. Whereas your seller will earn $5 from it. Now, my next example, if Facebook share price plunged to $5, the worth of the contract, okay, it's not, of course, it's not -$95, don't worry. Your worth of your contract, okay, it is still -$5, because this is how much you paid for the contract. That's it. Okay. So just take note, if the Facebook share price plunge, your maximum loss, I'm talking about your maximum loss for this example, for these two examples, is just the worth of your contract. Okay, I'm just calculating the maximum loss. And on the other hand, your seller will definitely earn the premium. Okay, this is just a very simple example. All right. So just take note, all right, this is a very simple summary for a call contract. So as being a buyer of a call contract, you will want the share price to be higher than the agreed price. And of course, being a seller of the call contract, you will want the share price to be lower than the agreed price. Okay, so this is how it works for call options. Okay. And now, coming to the end of the video. I hope this example, rather, I hope this video will give you a very, very brief introduction on call options. It is not the full thing, all right? It is just for you to appreciate, all right, how call options work, and this, will be part of the small little building blocks for the later portion of options. If I were to go in very, very deep, it will be very confusing for people who just started out options investing. And let me emphasize, options investing, it is a leverage tool. All right. Personally, I don't have a lot of options positions. I only go in, all right, when the time is right. At the same time, my whole options trade only make up 10% of my whole portfolio. 90% of my portfolio are in stocks, because I always believed in the effects of compounding. Right, that's my investing style. Okay, so with that, I've come to the end of this video. I hope you can like and subscribe, and do comment below to see if there's any things that you want me to talk about. And with that, invest safe.